Time for business news. The Central Bank of Kenya has yielded to pressure from financial institutions to have the interbank rate as the operating rate for loans, formally adopting the revised risk-based credit pricing model, which will now be anchored on the overnight interbank average rate. It will now be renamed the Kenya Shilling Overnight Interbank Average to align it to the international best practice, dropping the use of bi-monthly central bank rate. As Jimmy Mbogo now tells us in the following report, the move has been welcomed by the bank's umbrella body, noting that it will be key in ensuring faster translation of monetary decisions and enhanced transparency in the credit market.
The protracted tussle between the Central Bank of Kenya and the banking sector on risk-based pricing has come to an end, with the regulator yielding to the demands of the lenders to move the base lending rate from being pegged on the central bank rate, but rather on the overnight interbank average rate as proposed by the banks. According to the CBK, going forward, banks will be required to compute the total cost of credit by incorporating the Kenya Shilling Overnight Interbank Average (KESONIA) plus Premium K, which is the creditworthiness or risk of the customer, and the fees and charges charged by the banks.
Customers are always asking banks as to, my interest rate is at 17. How does it come to 17? So this is also going to be very clear. So number one is, when these are common reference rate, the KESONIA, it will be known to everybody, because on a daily basis you can be able to check the central bank website, be able to see where KESONIA is. So, and it will be across all banks.
To ensure that no customer will be left behind in the credit market, the central bank has further approved a credit information sharing mechanism that will see banks consolidate customer credit information in one portal for the credit agencies to assign a score, reducing conflicting credit information and rating disparities.
So we are happy to report that 2 weeks ago, Central Bank was able to approve a product that we've been championing through CIS Kenya on the fact that when banks send data to the credit bureaus, it ought to be a one portal. Then now these 3 bureaus can be able to pick that information from that one portal. So that approval has been given. We will not now have different bureaus getting different information from banks.
The bank has further argued that the revised risk-based credit pricing model is not meant to raise borrowing costs arbitrarily, allaying fears that those with lower credit risk might face discrimination, noting that all banks will now post their rates on the central bank website, allowing customers to decide what suits them.
Where you may find your risk profile may be at a higher level that one bank is saying no. But you should not stop there. What you should need to do is be able to look for information on banks that are interested in the area that you're playing in or in the segment that you occupy, and you'll actually be able to be accommodated.
Although the CBK has noted that the revised models will take effect from September 1st, 2025 for all new variable rate loans, the bankers argue that this is not enough time to have their models approved by their respective boards, a process that they say could take at least 3 months. They have written to the CBK for further clarification. And as banks prepare for the implementation of the new risk-based pricing model in the next 6 months, borrowers have been urged to work on their credit score to ensure they are eligible for lower rates beginning next year. Jimmy Mbogo, Citizen TV, Nairobi.